We are getting ready. The day is finally here. It's Fed Day. 30 minutes until the start of the cash trade. I'm Matt Miller.
And I'm Sonali Basak. Katie Greifeld is off today, and Bloomberg Open Interest starts right now.
All right, it is actually Fed Day. The debate has been raging for weeks, and today we're going to get the answer whether or not the cut will be 25 or 50. Plus, Citadel Securities quietly shelved plans to join the ranks of bond dealers that trade directly with the Fed primary dealers. Details ahead on that Bloomberg scoop. And more tax promises on the campaign trail. Donald Trump pledges to restore the SALT write-off that he capped in 2017. Let's take a look, though, first off at where the markets are trading. We do see green arrows in terms of futures. Right now, about 0.2% is the gain on S&P futures. NASDAQ futures are up about 0.3%. The 10-year yield right now up, but only by about 3 basis points. And typically, traders will sit on their hands on a day like today and wait until the decision comes out, maybe even the press conference, to trade on this data. Maybe, Sonali, they'll turn off the algorithms for a little bit.
Only 3 basis points. Any movement at all today is exciting because the only moment that matters is really 2 p.m. But some stocks are still moving. Of course, the M&A market is really what's heating things up. U.S. Steel climbing after the United States allowed Nippon to refile its $14 billion proposal to take over the American Steel Company. You have U.S. Steel up 3.4% pre-market, and General Mills now down about 2.9%. Moving following earnings, which came in line with estimates and reaffirmed its outlook. Remember, General Mills also working on a deal of its own to separate a business. Also watching communications company Intuitive Machines soaring after announcing a NASA contract worth upward of $4.8 billion. You have a more than 57% surge pre-market, Matt.
All right, 25 versus 50. That has been the debate. Here's what some of the biggest market voices have been saying about the Fed rate cut.
I mean, they're going to do it, 25, 50 basis points. It's not going to be earth-shattering.
The market has come to the view that 50 basis points at this meeting is, in fact, appropriate. It's pretty important that the Fed head back to neutral expeditiously, and that 25 basis points wasn't fast enough.
25 or 50, it doesn't make a difference. They're losing sense of the bigger picture. 25 basis points is going to be would be the right thing to do.
We're in the camp of 25, but I always say we have a crystal ball, and at the end of the day, we'll see what the market does. It may very well be that it doesn't make that much of a difference.
If they don't do 50 tomorrow, I'll be shocked. So they do 25 or 50. If they do 25, they'll lather it on pretty quick that they're going to do more later.
All right, it's another case of when the smartest people in the world disagree with each other. That always makes it fun, but I can't wait to find out.
That's what makes today exciting. There's also another set of people that says it doesn't matter, and the reason it's because the rate of movement into next year, into the next couple of years, is what really matters ahead. To me, also, it's interesting the reasons why. You have Bill Dudley really saying we're too far from the neutral rate, and the risks are really balanced now. Claudia Sahm talking about employment being a bigger issue. So what would really move the needle?
Yeah, I think it's interesting. I haven't heard anyone say it's imperative that they do one or the other, right? I don't know if anyone thinks that the world will fall apart if they don't do 25 or 50, but what's Michael McKee say about this?
Let's get to him. Let's find out. Michael McKee, Bloomberg's chief international economics and policy correspondent in Washington, of course, will be at the Fed while this decision is coming out there for the press conference. What are you looking for today?
I'm looking for either a 25 or 50 basis point cut. I don't know if I can say which one is more likely at this point. On Wall Street, it kind of depends on what floor you sit on. If you're in the executive suite or in the economist's offices, you're pretty much betting on 25 basis points. Everybody, all the big banks except for J.P. Morgan, are betting on 25. J.P. Morgan betting on 50. And we talked with Jamie Dimon last night. He said they should do 50, but he's not convinced they will. So we'll find out. But if you are on a trading floor, this is where you are right now. You're looking at a 67% chance of the Fed doing a 50 basis point move. We've come off a little bit on the lows there, but we're still hanging in there on more than 1/4 point move for investors. So it's going to be very interesting to see not only what they do, but what the market reaction is. is. A lot of stuff on the menu today. You were talking about that at 2 o'clock. We get the decision in the statement, and we will get an answer, 25 or 50 basis points. And we'll probably see them change the language to talk about further rate cuts ahead, which will keep people on track. New forecasts for growth, inflation, and unemployment come out. Do those square with then what we'll see in the new dot plot of rate cut forecasts? How fast will they go down? That is, as Sonali said, the key question for investors. And then at 2:30, of course, Jay Powell explains it all. At least we hope he does. And the markets can take away some sort of timetable and plan for rate cuts. But as was mentioned earlier, this is the first time since 2015 we go into a meeting not knowing what the rate decision is actually going to be.
And hope is never a strategy. Michael McKee, thank you so very much. We are looking forward to your coverage throughout the day. We are now joined by Lazard chief market strategist Ron Temple, who says that the labor market has downshifted from very strong to merely strong, suggesting that a gradual Fed easing is rather more preferred here than a more aggressive approach. So then what, Ron, would 50 say to the market?
Yeah, well, first of all, I think we have to zoom out. This is not an economy heading into recession, in my view. We've got a strong economy that's gone from very strong to strong. And the only reason I could see for the Fed to move by 50 is to take out an insurance policy. And I think it is critical, by the way, if the Fed does give us 50 today, that they need to reassure the market that the economy is strong, that the labor market remains strong, but that they've made so much progress on reducing inflation that it's time to rebalance the mandate, much like Jay Powell talked about in Jackson Hole.
In terms of, I mean, you've said the economy has gone from merely strong to strong. The labor market, I think, is easier to quibble on, right? I mean, because we've gone from 3.4% unemployment to 4.2%. The latter, though, seems more sustainable to me. What's your view on the labor market?
Yeah, I like to use the analogy. It's almost like you've been driving a car 90 miles an hour and you slow down to 60. It feels pretty slow, but you're actually driving at the speed limit. And I do think in this case, the economy's been growing above the speed limit for the last 2.5 years. We had real GDP of 2.5% last year. This year, the consensus is 2.5%. And through that period of time, we had very strong job growth. We had record high levels of unfilled jobs versus unemployed people. We had record high levels of quits, people quitting jobs because they get higher pay somewhere else. That's all normalized. If you look at these different numbers, 4.2% unemployment historically is full employment. And just keep in mind, 3.4% was the lowest since 1969. So effectively, I look at the economy and the labor market and I say it looks pretty good. Now, to be fair, 2 out of the last 3 months, job creation was pretty sluggish. So on average over the last quarter, 116,000 jobs a month. That's lower than I would like to see. And I think that would be the primary logic for the Fed to say, OK, let's go with 50, again, an insurance policy against further weakening in the labor market.
Well, let's also just talk about the playbook here, because we're talking about not just today, but the path forward.
Yeah.
And if they do 50, what is the risk that they're not unanimous? You pointed out to us that it was at least 2022 was the last time that there wasn't a unanimous vote. So what kind of issue would that create?
In some ways, I would expect this vote not to be unanimous. I think if you really were inside the room at the FOMC today, there's probably a real debate. And I think a lot of people are probably trying to figure out what the right answer is, as opposed to coming in ready to duke it out in terms of my answer is right or your answer is wrong. So I think there's a lot of uncertainty around what the right call is. And that's why I think if you do get 50, it's very important for the Fed to signal that there's not an emergency, that there's not something wrong with the economy. And one way to do that is through the statement, and others through the press conference. But the third is through the summary of economic projections. When they basically say where rates should end 2024, if you get 50 today and they say 50 additional basis points of rate cuts in total by year end, maybe that's one way to give the market a warm blanket to calm it down afterwards. Because I think one of the risks of 50 basis points is it says something's wrong.
Is it a warm blanket, though? Because you look at the Fed swaps pricing here, this idea that there's 115 basis points worth of cuts priced into the market right now. Is that an overcorrection? Is there
3% GDP growth, by the way, with 4% unemployment. Like, what's wrong?
With the equal-weighted S&P at a new all-time high at yesterday's close, with credit spreads still at very narrow levels, I do think there's an interesting disconnect here between the rate market, which is basically telling you we're heading into a recession and the Fed needs to hit the panic button, and the credit and equity markets saying things are pretty damn good.
Yeah, and don't forget corporate earnings, right? I mean, 11, 12% in the last quarter, and it looks like they're going to continue, and there's a broadening out of earnings. I mean, why do we really, what is restrictive about this? Like, where do you look in these markets and say, oh, 5% is way too
Jamie
restrictive?
Dimon yesterday was saying that everything is inflated still.
Well, I do think we still have inflation above target, right? We have headline inflation at 2.5%, down from 9.1. Core is at 3.2, down from 6.6. So again, those numbers can make you think maybe you should stay restrictive. But 5.25 to 5.5 is pretty restrictive. It's very restrictive at this point. So I do think.
I know, but based on what, Ron? I mean, where do you look and say, oh, that's because we have such a restrictive interest rate?
Well, if we look at just core inflation, we basically have a real rate of 2%. But if we look at headline, you're closer to 3. I think that, in many people's view, would be too high. I mean, I think what the Fed needs to be doing over the next 1 to 2 years is getting towards a neutral rate where they're no longer trying to fight inflation as it glides lower, but where they also have to focus on the other part of their mandate, which is jobs.
All right, we're going to keep you with us. We have more to talk about with Ron Temple from Lazard. By the way, you can watch our special coverage of the Fed decision, aptly named The Fed Decides, at 1:30 p.m. Eastern. It's Don't Miss TV. A check on futures here. What are markets doing ahead of this all-important decision? Could be the first non-unanimous decision since 2022. Well, S&P futures are up 0.1%. NASDAQ futures gaining about 0.25%. Remember, yesterday we actually had a big rally in the beginning of trading and went to at least an all-time closing high on the S&P. Came back off that by the end of the session. We closed at 56.34. The all-time closing high was 56.67. Coming up, Trump says he may restore the SALT write-off. That's the write-off that he took away as part of his 2017 tax bill. More on the implications that could have that could have on the race, on the deficit, on your budget. Next, this is Bloomberg. Let's get now to high interest to look at what's making headlines around the world. Hezbollah is accusing Israel of orchestrating an attack that killed several people and wounded almost 3,000 across Lebanon yesterday. Israel didn't comment on the events which injured so many members of the Iran-backed militant group, including an ambassador. The incident raises fears of an all-out war between Israel and Hezbollah. By the way, I'm talking about the exploding pagers, if you haven't gotten that yet. They got pagers to somehow explode. It's the end of an era for Steve Cohen. He is stepping away from the trading floor. The billionaire founder of Point72 will no longer be investing clients' money. He will instead focus on driving growth at the hedge fund and mentoring talent. He will remain as the firm's co-CIO. And of course, he's going to still be focused on trying to get the Mets into the playoffs and to the World Series. By the way, yesterday, Donald Trump said on Truth Social that he would consider getting rid of the SALT deduction cap that he put in place. A lot of people say to punish states like New York for not voting for him back in 2016. Now, this would be a great help to a lot of working families in New York and the tri-state area who have found it difficult to keep up with once-in-a-lifetime inflation. But remember, Trump also said he was going to build a wall and have Mexico pay for it. He was going to drain the swamp, and he was going to eliminate the federal debt and deficit. And of course, none of that came to be.
Okay, we're gonna talk about this much more with Bloomberg Balance of Power co-host Kayleigh Lines in D.C. And to the point Matt was making a little earlier, if you thought that SALT was, or Trump's moves on SALT was really a punishment to places like New York, then does a reversal of his decision here win him more voters in places that didn't really support him at first?
Maybe, Shonali, but it's really maybe less about earning him more voters than it is voters going towards some vulnerable incumbent Republicans in the House in swing districts that Biden actually won in 2020. So think Anthony D'Esposito or Nick LaLota or Mike Lawler outside of Westchester. These are members who could make or break the majority staying in Republican hands in the House. And this is something that they have been pushing for, at least an elevation to the cap for the state and local tax deduction. Of course, it may not be as popular with Senate Republicans who advocated for this cap to be put in place when these tax cuts passed in 2017, in part not just because of the impact it could have on these blue states, but also because of the way in which it helped the tax cuts in other areas, because this would be expensive. It would take a toll on revenue in the United States. According to the Committee for a Responsible Federal Budget, would cost $1.2 trillion over the next 10 years if this cap were to be lifted entirely. And that's in addition to the trillions of dollars more in lost revenue that could come from the other tax policy proposals that Donald Trump has put forward.
Right. Well, I mean, Republicans tend to fall in line when Donald Trump cracks the whip. I mean, at the end of the day, right, he runs this party. Let's talk about the Democratic proposal that we heard yesterday from Kamala Harris. She said she would limit child care costs, which is a huge issue in this election cycle, to 7% of income for working families. When she says working families, she means she's going to cap the income limit on that. What do we know about this proposal? Because it's the first time we've heard about it.
Well, we don't actually know much more beyond what she said, that she doesn't want working families to be paying more than 7% of their income toward child care. She didn't get more specific than that as to how exactly this would work and what families, to your point, this would apply to. Now, the administration already has been advocating for this. It was part of the Build Back Better agenda in 2021, and it already, through grants, has given this 7% child care cost cap to certain families of lower income through a grant program. So whether or not it would be an extension of this, if it would go widely than that, those are questions to this point have remained unanswered. What we do know is this is another instance of Harris talking about childcare. She, of course, has also advocated for a higher childcare tax rebate. Of course, that's something, a tax credit that J.D. Vance, the Republican vice presidential nominee, has also advocated for. So there may be some overlap on these policies here, potentially areas of bipartisan compromise if we don't get a sweep either red or blue either way. But once again, it becomes a question of the pay force here. Harris, of course, advocating for a higher corporate tax rate of 28%, a 28% tax on capital gains for those earning over $1 million a year. And the offsets become the question here as we look at potentially deficit additive policies for either candidate.
Yeah, Kayleigh, it looks like a lot of people want to do a lot of spending. No one really wants to pay for it, right? In the age of modern monetary theory, why bother? Kayleigh Lein's there in D.C. Thanks very much for that. You can follow the latest on the U.S. elections by typing ELEC-GO on your Bloomberg terminal. We're back with Lazard Chief Market Strategist Ron Temple. I hate the term working families. Like, who's not working, right? And what they mean is a $300,000 cap on family income. But if you're in the New York area and you're paying $30,000 a year for daycare and $60,000 a year for a nanny, and your school taxes are, unbelievable, how important is this SALT deduction?
Well, as a New Yorker, I think it's very important for a lot of people here because tax rates in New York City and New York State are so high relative to other parts of the country. And having that cap on deductibility has been a real constraint for people who would consider themselves middle class. So it's important. But what worries me about all of these tax proposals, it started with no taxes on tips. Now we've moved into child tax credits. Now we've got the SALT. It seems like it's Christmas time in D.C. and the terms fiscal and responsibility don't belong in the same sentence anymore. So somehow we have to pay for all of this. And kind of back to our discussion of treasuries earlier, over time, this will raise interest rates, which is a tax on families as well.
Well, there's another point that an investor made to me. And by the way, we are also, remember, talking at a time where we're trying to stave off a government shutdown at this point in time, too. This is a very real discussion. So anyways, this investor made this point that if you look at the bond market, that the risk about the federal deficit is already being seen in the bond market. Investors are asking you to pay for more. This 50 basis point issue here is not just about the economy. It's also about a risk premium being baked into the bond market. What do you think about that argument?
I'm not sure I see that risk premium yet. One of my concerns over, say, a 3 to 5 year time horizon is as markets realize neither party is serious about reducing the deficit, at some point, investors do have to demand that risk premium. And so when I think about fair value on a 10-year Treasury yield, I tend to think it's 4 to 4.5% today. Over time, that's going to grind higher.
It crowds out investment, doesn't it?
It does. I mean, you can't keep running deficits of 6% of GDP every year. And by the way, with some of these tax proposals, you're talking potentially 7, 8% of GDP. That is unsustainable because then you're adding to your debt at a faster pace than your income is growing as a country. That's a debt spiral.
This leads me to the phrase gridlock is good, right? We've heard that in the past. Okay, I've heard arguments against it as well, but come November, it's unlikely that one party wins both the White House and Congress, right? Is it better if Washington can't get anything done, or do you worry about things like the government shutdown that we're facing now in less than 2 weeks?
Well, my operating assumption, by the way, is there are two base case scenarios after the election. One is Kamala Harris is president with a Republican Senate. I think there's an 80% chance Republicans end up winning the Senate because there's 7 vulnerable seats, all Democrats. And if you consider Joe Manchin's retirement, you're already basically at a 50-50 because it's almost unquestionable that the Democrats could win that seat. So
what's the other?
The other scenario is Donald Trump with a Republican House and Senate. So I tend to discount Kamala Harris's tax proposals in terms of raising the corporate tax rate because I don't think she'll be able to get it through the Senate. And so, I think she might be able to get the child tax credit because it looks like there's some bipartisan element to that. I do think the one tax increase she would probably get is on households making over $400,000 because all of those tax rates expire at the end of 2025, so you don't need legislation to raise it. But if you have Trump as president with a clean sweep, he gets his trade policies through, which require no act of Congress.
By the way,
and he might get his corporate tax.
By the way, Ron, so the 2017 tax bill sunsets next year, including the SALT deduction cap. Do you think the Democrats want to raise taxes and keep the SALT deduction cap?
Well, I think the Democrats would probably want to remove that limit on the SALT deduction if they were in control.
Okay.
And so I do think, by the way, whoever wins the White House probably carries the House. And again, I think Kayleigh's point about the vulnerable Republicans is spot on in terms of raising that limit because the Democrats are really hoping to win the House in California and New York, where this is one of the most important issues.
But still not counting out a red sweep. This is as big of a delta as we see the 25-50 debate. Ron, we got to leave it there. That is Lazard Chief Market Strategist Ron Temple. Now coming up, Snap unveiling new augmented reality smart glasses. We're going to have details in today's Social Climbers next. This is Bloomberg. It's time now for Social Climbers. The company's making waves this morning. And first up, Sam's Club hiking its pay for hourly retail workers in a move to attract employees and compete better against its rivals. The Walmart-owned chain will increase starting wages to $16. Next, Accenture is delaying most of its staff promotions by 6 months, and it's the latest sign of a prolonged slump hurting the wider consultancy industry. Rivals McKinsey and Ernst & Young have been cutting jobs to weather the slowdown. Finally, Snap is unveiling new smart glasses called AR Spectacles. The glasses let users take pictures or videos and send through the Snapchat app. They also include AR technology that can overlay the world with digital filters, and it aims to compete with Meta, which released its own latest smart glass in partnership with Ray-Ban earlier this year. You can follow all the latest company buzz on TREN Go on your Bloomberg terminal.
All right, coming up, less than 4 minutes to go until the opening bell. We start the trading day with David Lefkowitz of UBS. This is Bloomberg. Moments away from the start of trading on Fed Day, this is Bloomberg Open Interest. I'm Matt Miller. We are looking at futures that are up slightly, but on days like this, traders tend to sit on their hands, turn off the algorithms, wait for the decision. Why get ahead of a speeding train? In any case, we do see a slight lift in the market after yesterday, a big rally at this moment in time, then turned around into the afternoon. You hear the opening bell here on the New York Stock Exchange, also on the NASDAQ marketplace. And, we're really watching for what happens. Is it a kind of buy the rumor, sell the news scenario? Will the market be disappointed with 25? Will we be all jazzed up if we get 50? That's the question that Sonali and I are asking. In terms of the cash trade, you don't have a lot of movement, right? Up about 0.1% on the S&P, the NASDAQ up a little bit more, and the small caps gaining as well. Obviously, if you did get a bigger rate cut, a lot of investors have been arguing that would be better for the small and mid cap stocks. Let's take a look at some of the individual movers. U.S. Steel is higher after the U.S. granted Nippon permission to refile its plans to purchase the American Steel Company for $14 billion. Could we have a turnaround there? Remember, Biden, Harris, and Trump all say they oppose the acquisition, but the CEO of U.S. Steel says we could lose jobs if they don't get to sell it. He might close down some of their smelters.
We always learn the hard way that reality is never black and white. But today, really good day here for Intuitive Machines, another stock moving under the surface. 50% higher nearly as the market opens, surging on a contract with NASA worth up to $4.8 billion. That contract is for communication and navigation assistance during space missions. Also, we had earlier mentioned 23andMe shares dropping. This is a crazy story. After all 7 independent board members resigned yesterday, they're protesting CEO Anne Wojcicki's plans to take the company private. The director said there hasn't been any notable progress on presenting a proposal. 23andMe holding down 2.7% of the market. Let's take a look at the stocks to watch following the Fed decision with Bloomberg's Abigail Doolittle.
Well, Sonali, let's actually also look at what the Fed may potentially do, because, of course, today the Fed meeting and policy decision, the press conference, front and center, one of the most highly anticipated meetings in 4 years, given the fact that it's expected that this will be the first cut or cuts in more than 4 years. So these are the odds of the possibility of a 50 basis point cut. So closer at this point. Bill Dudley, of course, earlier this week, former Fed president and Bloomberg opinion columnist, saying that the Fed should cut by 50 basis points, and he believes they will. Well, what's the effect on stocks? Today, clearly treading water, just very small gains there. Nobody wants to get out too far ahead of their skis. Relative to bonds, the Fed, the markets have really done the work for the Fed. Bonds rallying, treasuries rallying 5 months into this meeting. That 2-year yield down more than 150 basis points. Not surprisingly, then, some of the rate-sensitive sectors are the ones that are really outperforming this month. Utilities, those dividends look much more attractive when yields are down. That is also the truth for real estate and staples. We're just throwing discretionary in there. These are the best sectors on the month so far. But, Matt, what's really interesting here is you would think that big tech, that as more liquidity comes into the market, has actually come into the market ahead of these potential cuts with yields down so much that it would also fare well. Well, that's not the case. As the S&P 500 yesterday was flirting with an all-time high, the NASDAQ 100 still down about 6% from its all-time high. So mixed messages, and yes, it will be interesting to see whether or not it proves to be a sell the news moment, a buy the news moment, or if it's just all priced in.
Yeah, we're all waiting to see. Abigail, thanks very much. Abigail Doolittle with a look at some of the sectors that could be most affected by Fed rate cuts. UBS Global Wealth CIO of U.S. Equities, David Lefkowitz, joins us to talk more about this right now. David, what a day. We've all been waiting. I guess the first question that we ask every guest over the last few days is, what's your call? I mean, I don't know how much it matters whether we get 25 or 50, but what do you expect?
Yeah, I think your second part of the question is an important one. I don't know if it matters that much. We do think it'll be 25, but it's a close call. Obviously, you're getting a lot of mixed messages from the Fed themselves in terms of some of their speeches and press reports and things like that. But I think the more important takeaway is that this is the beginning of the easing cycle. The interest rates right now are fairly restrictive. We've got 5.33 on the Fed funds. Inflation is running maybe 2.5, 3. That's a pretty restrictive real rate, and the Fed wants to start bringing that down. And I think that's the main message I would take away.
It's interesting. Over a month, you're looking at 2-year yields roughly 45 basis points lower. Yet at the same time, you're watching the Mag 7 index down 1.7%. Over that same amount of time, the Philadelphia Semiconductor Index down 5%.
Yep.
So have the moves already been made in the stock market that would have been reacting to these cuts?
Yeah, look, I mean, the market is basically at all-time highs, right? So, clearly there is a lot of good news priced in. I think the soft landing is kind of consensus. But I would also say, if you look back at, we have to look at the full year here, right? I mean, tech stocks had a fantastic run. They're taking a little bit of a setback. I wouldn't even call it a setback. It may be a little bit of a pause. But when we look at the trends for technology, and especially for AI, we're not seeing any problems there. I mean, you listen to company management teams, we're still talking about lots of capital spending in the months and quarters ahead. We think earnings are still rising pretty nicely for a lot of the tech companies. So, but yeah, sorry. Yeah.
Earlier this year, I think we would have talked to you about technology in terms of a discount rate here.
Right.
And the valuations.
Yep.
But, you're talking about earnings, totally sensible. In that case, what is the trade on the heels of a rate cut?
Yeah.
What is so rate sensitive that it could see their stock price move on the heels of it?
Yeah. So I think it's a couple small parts of the market, because let's bear in mind that the long end of the curve, the Treasury curve, has already moved down, right? So we're not looking for a lot more of a decline in that part. So it's really what parts of the economy or the market are really sensitive to declines in short-term rates, right? So you think credit card rates, right? Maybe auto loans. Maybe people take out a home equity loan to do some renovation on their house. Maybe some of the regional banks, right? So I think it's going to be a lot more targeted than, and you know, in small caps, you know, companies that do have floating rate debt. You know, we haven't yet seen a pickup in earnings growth for small caps. That's been a big, I would say, headwind for small caps. It's certainly possible we start to see that, but you know, we're neutral on small caps. We think it is still late cycle. You want to be cognizant of some of the risks, and small caps are usually best in the early part of the cycle.
When I hear you talking about AI and how well everything is going, I can't help but think about Cisco selling so many routers in 1999 and 2000.
Right.
Do you not? I mean, maybe you weren't there, right? But
I was there. I just wasn't paying attention.
I mean, you were 8,
That's
right?
fair.
So, but you know, I started covering the market in 1999, and we watched the enthusiasm, you know, and rates were on the way up there, start to fade into 2000. Then the market came down. Then we got the rate cuts. Don't you see any parallels between NVIDIA and Cisco?
Look, I think there are some similarities, but I think there are more differences. Yeah, I think there's a major question that still is on investors' mind is, will there be return on all this investment spending? And there's a lot of investment spending going on. But yeah, look at the reports that we just heard about Jensen having a meeting with Larry Ellison and Musk, right? They're dying to get their hands on GPUs, and they're fighting with each other about who's going to get the bigger allocation. So these are...
Back then, we were paying so much for every mile of fiber, remember? I mean, we got to lay the groundwork for the internet, and we did have to, but it didn't pay off for another 5, 6, 7, 8, 9, 10 years.
And a lot of companies lost a lot of money doing that, right? So look, I think it's a risk. I would say, though, I just think it's premature. I mean, we know we're going to get next generation of these models. It's going to take 10 times the compute to scale up these models. And then there's probably going to be another generation after that that's going to be even more compute intensive. And, you know, until the market gets a better sense for will these models and the applications that are going to be built on top of the models, will they actually live up to their promise? I think the market's going to continue to fund this. Like, look, every venture capital firm, I have to imagine, every Fortune 500 company is trying to figure out their AI strategy. I just think it's too early at this point to be concerned about generating returns right now.
I'm begging for the possibility to IPO. David, thank you so very much for your time. That is UBS Global Wealth CIO, head of U.S. Equities, David Lefkowitz.
Usually I'm the bull, right?
You usually are. I'm shocked today.
I'm trying to offer just a little bit of warning.
Wow. Well, thank you. It's a better day today.
And to set up our next guest, right? Because
true.
we're going to be talking about those.
Optimism. We're going to talk about CEO optimism. It's important in this economy right now. We're going to chat with KPMG U.S. Chair and CEO Paul Knapp about all of that next. This is Bloomberg.
It is time now for our top calls. Some of the analyst action in focus this morning. First up, Needham & Company is initiating coverage of Supermicro Computer with a buy rating and a $600 price target. The analyst says the chip company has a first mover advantage in the artificial intelligence space. Next up, Barclays says Victoria's Secret is no longer a sell. The firm is raising its rating on the lingerie retailer to equal weight, saying the worst is behind the company. The analyst says the appointment of Hillary Super as CEO is encouraging. And finally, Truist Securities says Insight is no longer a buy, downgrading the biotech to a hold. The analyst says the company is facing a patent cliff and notes increasing competition in the oncology space. Sonali?
Matt, we're going to now turn to the C-suite because CEO confidence is a very large barometer of many things, and KPMG has surveyed 400 U.S. CEOs to gauge their views on the economy, their company's challenges and opportunities. Joining us to tell us what they found, KPMG U.S. Chair and CEO Paul Knapp. And if you look at the survey, it's very interesting because on one hand, more than 3/4, or roughly 3/4, say that they are confident in growth prospects, but they're also worried about the the economic uncertainty. How do you make sense of both things at the same time?
We've been through a lot. We've navigated and been very resilient, a lot of different challenges. Some of those challenges persist, though. Geopolitical complexity for the last 2 years in particular. No doubt some political uncertainty in the U.S. And then just the economic uncertainty emanating from inflation, which we had not seen in years at these levels, along with much higher rates. Despite all those challenges, we've run businesses that have been very successful. So there's a lot to worry about, including the evolving nature of cybercrime, too.
I got to say, to me, the confidence numbers look overwhelming. Yeah. I mean, we're talking about 85% confidence in economic growth in the U.S., right? 78% confidence in their own companies, 74% confidence in global growth.
Right.
Are those normal numbers? Because that's a lot.
A lot of confidence.
Well, Matt, those numbers have stayed pretty consistent the last 2 years in this survey. I do believe it's because of that resiliency I spoke about earlier. But I think it's also just the waves of innovation that are happening, both when it comes to generative AI and AI, when it comes to more renewable sources of energy. The labor market is remaining pretty tight at the moment. So you just look at the U.S. and the global economy, we are pretty optimistic about prospects for growth moving forward in the future.
So I think one very important question here is the way that CEOs are thinking about labor at this juncture, because there is this sense that the risks are really shifting to a more balanced set of concerns around inflation and employment. But to the extent you see companies that are pursuing layoffs, how much of it is actually tied to interest rates? Because would a cut really prevent them from making those job cuts, a rate cut?
Yeah, so it's very much a sector-specific story. So, of course, loan origination, for instance, in housing, that's going to be interest rate sensitive. But for almost every business industry, it's going to be more about product and service demand and the picture of that for each business and industry. So it's not so sensitive to rate cuts or increasing rates. Of course, now increasing rates, we're crowding out certain other spending over the course of time. But the great news is that we seem to have clarity now around the direction of interest rates. We have some clarity around inflation cooling, although prices will probably be a little sticky and stubborn moving forward in the future.
Well, how might that set off M&A? Because you are seeing a lot of deal making happening, but it's more spin-offs than anything else at this rate. So do you think companies will get out there and get confident to buy things once again?
Yeah, what we're seeing in this survey is real thirst for M&A. About 90% of CEOs saying moderate to significant M&A over the course of the next 3 years. For the corporate environment, more back-ended in that 3-year time frame. They're saying more like 2025, early 2026. For the private equity picture, it's definitely the case that a rate cut of as much as half a point over the course of the next few months will likely ignite some real activity. That sector's been pretty quiet when it comes to buying and selling, although there has been some sell activity and some carving out, as you say, spin-offs. But for that sector to really get ignited, we're going to need some interest rate action to the downside. And when it happens, we think that there'll be a significant pickup in that activity sometime, hopefully in 2025 or 2026.
Janelle, I mean, to the M&A point, do you include IPOs there? I mean,
wow.
Would a rate cut help improve IPOs, or does it do the opposite since they can borrow cheaper?
It depends, doesn't it? Because if it depends on whether you can sell for more or sell to a public market for more.
Yes.
So are companies willing to pay up? You see the market, the equal weight S&P hitting a record in recent days. Does that mean valuations are correcting enough in public markets that makes being public more attractive?
So I think the story on IPOs is very much a valuation story, almost full stop. And the general economy improving with lower interest rates will help, but it's still a case of, in some cases, sticky high valuations that have been part of the challenge. And as we move forward in the future, and there's a bit more price discovery and clarity around these valuations with hopefully a more normal interest rate environment, you might start to see more activity in the IPO market too.
And so, yeah, that would make an IPO more attractive. However, you also have an election and potential more volatility, so we'll see.
Yeah, maybe wait and see is what at least half of the CEOs in the survey are basically saying, right? Election, political uncertainty, and geopolitical uncertainty. Paul, thanks so much for joining us. Paul Knopp there, KPMG's U.S. chair and CEO. Coming up, we're going to talk about why Citadel is no longer pursuing a decades-long plan to join the list of Fed primary dealers. That's next in our Wall Street Beat. This is Bloomberg. This is Bloomberg Open Interest. Quick check on what's going on in the stocks world ahead of the Fed decision this afternoon. A whole lot of nothing. You can see at least on the S&P 500, right? Unchanged there. The NASDAQ near as damn it, and the Russell 2000, the only sincere gainer, up 1/3 of 1%.
And it's time now for the Wall Street Beat. I've been waiting to talk about this story all morning. Citadel Securities has quietly shelved plans to join the ranks of bond dealers that trade directly with the Federal Reserve. Citing success in its treasury trading business, Bloomberg's Liz McCormick reported on this exclusive. She joins us now. I feel like I've been waiting years for Citadel Securities to have become this primary dealer. Of course, it would have been a big move for them to have done this. Of course, they're massive in the treasury market already, but how much does it matter that they're not taking that extra step?
Yeah, so I think what's interesting, and it has been years, is that, to be clear, the firm has long said that their goal was to kind of build their franchise to be a big market maker in treasuries, as they added every slice of treasury securities you need to, from bills to off and on the run, et cetera, over the years. And they felt like at the time that eventually being a primary dealer would be part of the process. And what's interesting is that they've kind of achieved those objectives, at least for now. And what seems like, given the changing of the marketplace, they don't quite need the bid to be a primary dealer now. We can't say no, never, but I think that's the net on this. And it's been years in the making, is that it's like achieving your objective without one, notch that you thought you needed to get there. So I think for now, that's why they're saying they're putting this aside for now. They're building their franchise, and it's been working. And, in the old days, Shonali, many clients only wanted to deal with a primary dealer. And that's kind of changed as these other market makers have become big liquidity providers and treasuries.
Does a primary dealer essentially have a license to make money? Is that part of the agreement? Has that been that way historically? Has it changed?
Well, I don't think so, Matt. In fact, I won't say names, but, some of the primary dealers, there's a cost to it. You're required to bid at a certain level at the auctions. There's a bit more oversight. So anyone looking to be a primary dealer, there's always a cost-benefit analysis. And as you know, at one point we had over 40 primary dealers, then it fell below 20. Now it's at 24. So there are different incentives and reasons why people want it. And I think for now, Citadel Securities, the benefits have waned a bit to them, and they, have come to the conclusion for now they don't need it. I don't think it's a pure moneymaker. They do get access to certain Fed programs that no one else does. So, and certain things the Treasury does. But I think you have to weigh that against other things.
Liz, let's talk about market structure for a moment here, because I heard Nellie Liang yesterday speaking, the Treasury Undersecretary who really deals with this sort of stuff. And you cite a Stanford professor in your story that says the share of new treasuries bought by primary dealers has dropped to around 10% from 20%, roughly half before the 2008 financial crisis. If you don't have more primary dealers like a Citadel Citadel Securities trying to step in, does it draw larger questions about market liquidity in the future?
Well, I think, we have to remember that the markets are the primary, Treasury's new auctions of securities, which, like you said, that was Daryl Duffy at Stanford saying even at those new, because the Treasury allows direct bidding and there's another form, indirect. I won't get into the wonkiness of that. But so the primary dealers he's laying out, taken a less share over the last 10 years. But in the secondary market, one of the big issues where we've seen those dearths of liquidity that we have all this market structure, like the move to central clearing, that's the secondary market, Shonali, as you know. And that's where Citadel Securities is kind of a whale of a market maker. So I think you're looking at two things. I have had some folks, former, let's just say, regulatory folks say Treasury always likes, more primary dealers. They're kind of the boots and suspenders of making sure auctions go well. But we have seen the structure change, like Daryl Duffy laid out.
All right, Liz, thanks so much for joining us. Liz McCormick there talking to us about this Bloomberg scoop. Citadel Securities no longer aiming to be, at least for now, a primary dealer. Coming up in the next hour, BlackRock's Kate Moore. One sector that she's watching post-election, or she's going to tell us one or maybe more of the sectors that she's watching post-election. Also, Bess Friedman joins us from Brown Harris Stevens to talk about the effect that we expect interest rate cuts to have in the real estate market. That'll be a very interesting conversation. This is Bloomberg. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Sonali Basak. Katie Greifeld is off today. And coming up, Fed Day is finally here. The debate has been raging for weeks, and today we're going to get an answer whether that first rate cut will be 25 or 50 basis points. And more tax promises on the campaign trail. Donald Trump pledges to restore the SALT write-off he capped. Matt is going to want to talk a lot about that. Oh, and so am I, actually. We're going to also discuss that and more with Brown Harris Stevens CEO Bess Friedman and BlackRock's Kate Moore.
All right, let's get a check on what's going on. There's not a lot going on in the stock market right now. We're unched on the S&P 500. The NASDAQ is up, but only 0.1%. The 10-year yield, I would say, only rising 3 or 4 basis points.
Only rising 3 basis points. Nothing's happened yet.
Okay. So we're moving around a little bit in the bond market, and that isn't unusual, right? We've seen, as everything else calms down and gets back to normal this year, you still see bond market volatility.
You sure do.
Which we've been talking about. PIMCO's Dan Ivison says the market has priced in too many Fed cuts. He joined Bloomberg's Odd Lots podcast earlier.
We do think that the markets may be getting a little bit ahead of themselves in terms of near-term cuts. Yeah, we've had some employment weakness, but then we had a CPI number recently that surprised a bit to the upside. Earlier this year, data surprised in a more concerning fashion. So we think that, over the course of the next few months, there are some risks of reaccelerating inflation, which may lead to less cuts that are priced into the market.
Let's take a closer look at some of the Fed predictions here. Joining us now is Anna Wong, chief U.S. economist at Bloomberg Economics. I'm going to save that 25 or 50 question for Matt for a second here, because my question is it more important, that first cut, the scope of it, or is the dot plot actually more important here, the path forward?
Right. I think the dot plot is what will move the 2-year and 10-year yields most. And right now, market is pricing almost close to 120 basis point of cuts. That may be a little bit too optimistic, so I agreed with PIMCO CEO there. I think the Fed is most likely to write down the dot plot of about 100 basis point of cuts today.
And we know that you expect a 50 basis point cut. We've been talking about your call. And Bill Dudley made the same call on a Bloomberg opinion piece yesterday. My question is why? I mean, if you point to the labor market and say, it's reached a tipping point, and once we get, an additional 60 basis points of gains in unemployment, that accelerates. I have to say what Jerome Powell said, which is, the labor market, the labor pool has grown so much as we get so many foreign-born workers, so many immigrants coming in and making it bigger. It's not that you've got layoffs. What's your response to that?
Yeah, I think the number one issue is how confident is the Fed about job hiring. So we have seen in the last couple of months that jobs last year has been revised down by 818,000. And we also had a Fed who was pretty confident that the break-even pace of job growth in this economy, given all the immigration, should be about 250,000 jobs creation per month. So now the 3-month moving average of job growth is about 116K if you take the number at face value. But really we think it's more about 20,000 per month, well short of the 250,000. So I think from the Fed's perspective, they're probably talking about, are we confident that the job growth is really at 116, which is half of the pace they need, which means unemployment rate would be on the way up.
And are they unanimously confident is what I want to know.
Well, yeah, we're waiting to see if they are all on the same page. Maybe not, right? That's one of the exciting things to watch for. Anna, thanks so much for joining us. Anna Wong there of Bloomberg Economics. Kate Moore joins us now. She's head of thematic strategy for BlackRock's Global Allocation Investment Team, and she is with us now. She says she's concerned about the potential market disappointment if the Fed doesn't cut 50 basis points today, Kate. And they kind of have set it up that way, right? I don't know if they've telegraphed this to the market, but they've allowed expectations to run wild unchecked.
Yeah, I think that's right. And the market has moved really quickly to price in 50 basis points. But I think you guys have talked about this earlier, and I heard it earlier this morning on Bloomberg as well. Most economists, including some of our own, are still forecasting a 25 basis point cut based on the economic fundamentals. Because let me just make very clear, we don't think we are tipping into a recession anytime soon. We think the economy has slowed significantly, but we are not in a danger zone. And so the question really is, does the Fed worry about an acceleration of the slowdown, or are they going to try and catch up from where they think they should have cut earlier? And kind of how do they position it? What is the language? And of course, what are the forecasts going forward?
So given how much the market has already moved, you've seen such a drastic repricing in bond markets, and you have seen, let's say, a muted reaction in the stock market, right? I mean, you've seen kind of downturns, light downturns in those big tech sectors in the last month, where you've seen that same move in bonds. If we don't see 50, then what does the correction look like?
I don't think a correction would be sustained. I think that there would be opportunity to buy, particularly higher quality parts of the market. But I will say there are three things that are really overhanging equity sentiment at this point. First and foremost, I would suggest is actually earnings. What we experienced as we went through earnings season for the second quarter was that revenue growth was pretty disappointing, even as companies delivered on the bottom line. And so I think there's some concern that companies may have less levers to use to deliver on the bottom line for third quarter earnings. And I think people are going to be really focused on that top line number, on the revenue growth. So I think that's number one. Number two, of course, is what I'm calling the macro political scene, which includes U.S. politics, international politics, geopolitics, and then policy implications. I think there's a reluctance by a lot of equity investors to make big position decisions ahead of the U.S. election, since there may be some policy shifts. And the third thing I would sort of mention is there is that fatigue around AI, which we've been talking about a lot, right? And concern that if we don't get more use cases or more examples of AI monetization, as companies discuss through both conferences and also reporting over the next couple weeks, how they are really making use of their investments, that people will kind of fade that trade for a little while.
It's interesting. We were talking with David Lefkowitz from UBS, and he was talking about, the money being made in AI, at least by those obviously selling, the picks and shovels, is real. Then we talked to Paul Knopf from KPMG, and he said it's pretty much the number one concern for CEOs about their own company is keeping up in terms of the AI space race. But does this look though, Kate? Does NVIDIA eventually look like a Cisco? I mean, they were killing it in 99 and 2000, right? And now some people don't even know what Cisco is.
Well, I think NVIDIA is an amazing innovator, and they have new product coming out, at least on an annual basis. So I'm a little less worried there. I think your point is right, though, Matt. I mean, CEOs, CTOs, CIOs are all very concerned if they don't make investments now. If they don't lay the groundwork, if they don't create the architecture, if they don't retrain their people, that they're going to be left behind. And I think as we move into 2025 and beyond, as some of these investments are more codified, we will see a real differentiation between winners and losers in every industry. People who are effectively harnessing technology tools and those who are not. And that's going to really show up in the fundamentals, particularly in earnings.
It's interesting, kind of this idea of fading the move here in AI until we get more information. On the flip side, we've actually seen a lot of movement on the uptrend on things that are not AI, semis, big Mag 7 names. You've seen the equal rate just hit another record yesterday. What is driving? How sustainable, Kate, is that?
Well, look, if we have a Goldilocks scenario here where the Fed is committed to continuing to ease at a kind of steady pace and they are not overly concerned around a deterioration in the economy, and we end up seeing, rates coming down and releasing some pressure off a number of different industries, that can really extend the cycle. Remember at the beginning of this year, many strategists, many portfolio managers were hoping for a broadening out in terms of equity leadership. It is possible that if we get a slow and steady growth rate and easing policy, that we have a slight rotation in leadership. By the way, I don't think the market can take off to huge new highs without some technology participation, but we could even see some rotation within tech as we move forward. So we're kind of, keeping a little powder dry at this point and waiting to see both what happens in terms of the fundamentals and policy and in earnings to take advantage of new opportunities into year end.
How long do you have to wait and see in terms of policy? Obviously, we have the election in November. Sonali and I were talking about this earlier this morning. If we get one candidate winning, one party winning the White House and another party controlling Congress, then you really don't know until deep into 2025 what's passable. Obviously, if you get a red sweep, as I think we heard earlier, Ron Temple was saying that's one possible scenario in his playbook, then I guess you could go right away. But isn't there like some leeway there in terms of when you know what's actually going to be put into practice?
Yeah, 100%. And look, everyone on the street is rushed to put out their election playbooks in each of the different scenarios, which sectors, which industries, which companies will do particularly well. I understand the client appetite for that type of playbook. At the same time, Matt, you are spot on. We're not going to know into the early part of next year what can really get done on policy. We may hear Republicans and Democrats put policy programs out there, but how much can get done is going to depend on the composition of Congress and, a couple new congressional leaders that may actually swing votes. So we are not positioning at this point for the election. And I think we're going to wait and really kind of take our time in assessing the potential policy impacts of November.
Kate, do you ever think about kind of the market dynamic now, such that, over the last couple of decades, there have been fewer public stocks, and somebody at your shop had told me this, just the math would bring you towards elevated market levels over time, because as people look to put their money to work, as people look to retire, that means more demand coming into the market, but the supply of investments remains the same or lower. Does that make any sense to you here, that really boats have to be lifted here to some degree?
Yeah, look, the market technicals have changed a lot over not just the last few years, but I would argue the last 10 or 15 years. And as we think about money that's been on the sidelines, it's been waiting for the right opportunity to invest, both in stocks and in bonds, the implications of flows should never, ever be disregarded. So we pay very close attention to this. And I do think there's more opportunity for investment in the stock market going forward. But that doesn't mean it needs to happen before year end. People can average their way in, which is often the way that financial advisors advise their clients to get invested. And I do think that will mean even more money pouring into some of these mega caps as they invest in index and hopefully active product as well.
Kate, thank you so very much. That is Kate Moore of BlackRock. Happy Fed Day to you.
Happy Fed Day.
Don't forget, you can watch our special coverage of the Fed decision starting at 1:30 p.m. Eastern, only here on Bloomberg Television, of course. And coming up, we're going to dive into the presidential election tax proposals, or lack thereof, rather, the rewind of them. Trump is planning a reversal on the SALT cap. It's Matt's favorite story. He's been talking about it all year. We're going to dive right in. This is Bloomberg.
Let's get now to high interest to look at what's making headlines around the world. Hezbollah has accused Israel of orchestrating an attack using pagers, like beepers, that simultaneously exploded, killing several people and wounding almost 3,000 across Lebanon. Israel didn't comment on the events, which injured hundreds of members of the Iran-backed militant group Hezbollah, including the ambassador from Iran. The incident raises fears of an all-out war between Israel and Hezbollah. Campari's CEO has resigned effective immediately after just 5 months on the job at the Italian beverages group. Shares in the company fell last Friday after he spoke bearishly about the U.S. market before the company issued a statement clarifying that he was referring to sector trends rather than company performance. Campari said his resignation was for personal reasons. I recommend it with orange juice. Donald Trump said he would revive the state and local tax deduction, a popular tax break for New Yorkers that the former president took away during his time in the White House. And it's exciting to me, Sonali.
It has been exciting to you. Correction from my earlier statement. It has been exciting to you for the last 2 years. We're going to discuss it now with Bloomberg Balance of Power co-host Kayleigh Lyons in D.C. Let's first talk about the rationale here from the Trump campaign to really make this move at this point in time. Why do you think it's really so front and center?
Well, I'm not sure we have answers or rationale when he makes this specific announcement or any of the announcements he's made at any given time, because it does feel like every time there's a rally, there is a new policy proposal put forward. This one he previewed. The rally, of course, takes place in Long Island this evening, and he said one of the things that he'll bring back for people there is the SALT break. Haven't gotten much more detail than that. We don't know if he's talking about just raising the cap or making no cap entirely. There hasn't been specific outlining of that proposals. Maybe we will get it when he appears at the Coliseum this evening. But this is just one of a piecemeal kind of tax policy platter that he has put out there. He doesn't want to tax Social Security, tips, overtime hours. He wants to lower the corporate tax rate for companies that make goods in America, all of it adding up to potentially trillions of dollars more to the deficit if it's not properly offset with spending cuts. Frankly, there isn't enough non-defense discretionary spending projected in the U.S. over the next 10 years to actually cover all of this. He says tariffs will help do it and higher growth.
I mean, yeah, if you have tax cuts, for example, if I got massive tax cuts, I would pour all the money I saved directly back into the economy. And that's the idea, right? That tax cuts can spur growth. That's the hope, right? That's kind of the Laffer curve that for many years was ridiculed after it drove so much growth in the Reagan and Bush eras. What does Kamala Harris think about the SALT deduction cap? Because she's going to win New York anyway, right? So she doesn't really have to dangle that kind of thing. And kind of soak the rich is the platform of the Democratic Party anyway. So does she have any incentive to remove that cap?
Well, Democrats, by and large, Matt, especially in states like where she heralds from, California and New York, would like to see the SALT cap go away. The Senate Majority Leader, Chuck Schumer, has suggested if they do indeed keep the majority, this is going to be a high priority. He told that to Anne Marie Hordern at the Democratic National Convention in Chicago just weeks ago. So this is likely something Democrats would advocate for, as their states tend to be the ones that are affected most by this. However, I think it's less about the different presidential candidates and more about the balance of power in Congress. The House Republicans, of course, have a majority in part because of districts in New York that Biden won, but they were able to have Republican House seats when in those districts. Those are the majority makers. So like Anthony D'Esposito, whose district it is that Trump is visiting today, or Mike Lawler or Nick LaLota, for example, those are the members that have been advocating for a higher SALT cap. And those are ones that could see a benefit from this kind of policy position being put forward by the Republican ticket. So maybe it's more down ballot considerations that we have to be thinking about here. But yes, this is an area where you could actually see overlap no matter who has control. This could be an area of bipartisan compromise if Donald Trump is for it, and so is the Democratic Senate Majority Leader.
Let's talk about also the more recent conversation that the Harris campaign has been introducing as well. Childcare has, of course, been a big issue among voters. She's seeking to cap childcare costs at 7% for working families.
For working families.
You want to define
Does that mean
You're better
for any
at this.
family where like both people work? Is that what she means by that?
If I were married to you, I would definitely let you run our household budget. I will say that.
We'd be broke.
But to that end, you know, to the proposals that are being put forth by both sides at this point, what would actually meet the light of day? Are these largely a way to win voters over, or is it a more realistic plan?
Well, it may be a way to win voters over, especially middle-class voters that Kamala Harris specifically has been trying to speak to. I think that's primarily who she's talking about when she says phrases like working families. This administration already has introduced a 7% cap on child care costs as a percentage of income for lower-income families through a grant program. So it's unclear. She didn't get specific enough as to how exactly she would like to see this implemented or for whom. But yes, it will require congressional approval in all likelihood, and that isn't guaranteed, especially if there isn't a blue sweep, if she is indeed victorious in the presidential race. I would point out that the child tax credit is something that could see more bipartisan compromise. J.D. Vance, the vice presidential nominee on the Republican side, has been advocating for a higher child tax credit as well, in addition to Kamala Harris. So there are some overlaps in the Venn diagram here. The question does become around the pay-fors that each of these candidates are suggesting. Kamala Harris wants to see a higher corporate tax rate, 28%, higher capital gains tax rate for high earners over $1 million of 28%. While Donald Trump is looking at things like tariffs and, to Matt's point, growth in order to offset the decreased revenue that would result for some of these lower taxes and increased tax rates. By and large, though, what most economists will tell you, and budget watchers like the Committee for a Responsible Federal Budget will tell you, is that this is likely to add to the U.S. deficit no matter what way you slice it, if these policy proposals put forward by these candidates actually come to fruition. But again, that's a big if. The balance of Congress matters very much here.
Yeah, absolutely. And a blue sweep doesn't seem terribly likely if you consider how many Republican how many Democratic seats are at risk in the Senate. Kayleigh, thanks so much for joining us. Bloomberg's Kayleigh Lyons in Washington, D.C. You can listen to her, as I do, every day starting at 1 p.m. on Bloomberg Radio, or watch her on Bloomberg TV. They come back at 5 p.m. as well. It's my favorite show, Balance of Power.
Right now, it's particularly relevant, but also to that point on the SALT cap, you have Chuck Schumer saying Trump's vow on that deduction is an empty promise.
He said that yesterday.
So how does it get through?
I mean,
how do you get your
has
breaks,
made,
is what I want to know.
Schumer has, and they'd be breaks for you too, and millions of families that are struggling to deal with this once-in-a-lifetime inflation. Schumer has said that getting rid of the SALT deduction cap is a priority for him as well in the past. His point is that he thinks Donald Trump is just pandering as he's going to talk to Long Island today. Interesting, though, because obviously Trump isn't going to win New York, right? That's part of the reason that he put this cap in, as kind of a punishment to New Yorkers for not voting for him.
Like everything else, it's political.
Yeah, absolutely.
Where's the economics, Matt?
Well, you know what? I feel, like I said to Kayleigh, I think a lot of people would pour that money straight back into the economy. Still ahead, it's the end of an era for Tupperware brands. Speaking of families, as the food container pioneer files for Chapter 11, Social Climbers is next. This is Bloomberg.
It's time now for Social Climbers. The company's making waves this morning. First up, United Auto Workers will ask members to greenlight a strike against Stellantis. The move escalates an already tense standoff with one of the world's largest car manufacturers. Finally, Tupperware is filing for bankruptcy as demand falls for its once iconic food storage containers. The company's popularity exploded in the 50s as women held Tupperware parties to sell food storage containers as they pushed independence. But the brand lost edge to rivals that were making cheaper and more environmentally friendly containers. You can follow all the latest company buzz on TREN Go on your Bloomberg terminal.
This is Bloomberg C-Suite Next. U.S. mortgage rates dropped last week to a two-year low ahead of expected Fed rate cuts. The contract rate on a 30-year fixed mortgage dropped 14 basis points. That's the seventh straight week of decline, bringing the rate, that's what you want to know, to 6.15%. Last month, real estate investor Barbara Corcoran told us she believes a Fed cut would drive pent-up demand for housing.
And if you would take my advice, I would say get out there, because what you have right now, which you won't have if rates come down another point, they just came down, but you need one more point to bring everybody out into the market. And what's going to happen is you're going to pay more for the house. So what have you really gained by paying the landlord over these years and taking the increases in rent? Not much, because prices have gone up. But wait till you see what happens with prices when interest rates come down another percentage point.
Joining us now is Bess Frieden, CEO of Brown Harris Stevens, a national real estate firm serving New York, Florida, and Connecticut, one of the most popular here in the city. Bess, thanks so much for coming in. Great
Thanks
to have
for having me on. And by the way, I agree with everything that Barbara said. She's so smart and she's right on point about rates. I think it will have a positive impact in the housing market, and we need it. It's no secret that the market has been sluggish.
In terms of actual movement, but I wondered about price. Like, are you worried that we start to see prices already high, right?
Yeah.
Affordability already super tough, just shoot higher?
I mean, I don't know. It's unclear. And obviously it's going to take time for this cut to have an impact, but already rates are down, the lowest they've been in 2 years. And a lot of people, analysts are saying that they're going to go down a 30-year to the high fives, maybe even lower. And you're going to get sellers who haven't been willing to put their homes on the market now saying, you know what, this is doable, 5, 6, I can live with that. I can, accept a mortgage at, 6%. And then you're going to see buyers who've been on the sidelines willing to get into the market. So what this does is improve supply and demand, which is the central nervous system of our housing market.
It's interesting. There was data this morning about U.S. housing starts increasing to the fastest pace in months since April. And if you have more supply coming into the market, and also so many people waiting on the sidelines, there was an argument I heard recently, just to play devil's advocate here, that said, okay, well, wait a minute. Once people start buying again, and you have a reset of prices, that reset might not be higher. It might actually be lower. What do you think of that argument?
I mean, I think it's possible. And remember, this is such an inexact science. Housing is an emotional commodity. People go into it because they have to buy or they have to sell. And prices are going to change. Real estate is very local. For example, in New York City here, we have ample supply. In places like Palm Beach, we need more supply. So it really depends on the market and what the demand is and what the supply is. But I do think that this change in Fed policy is a gesture of optimism. It means the economy is steady. It means that we've avoided a recession. We've hit that soft landing. It's like, you remember when Sully landed that plane on the Hudson?
Yeah, I'll never forget.
Chairman Powell is like Sully right now. He's landing the economy very, in a tough time. It's been a tough market. And so right now it feels good, and it's okay to feel good about this, but it will take time for it to unfold.
I am shocked that we've spent this long without talking about that SALT deduction.
Oh.
Do you want to get there?
Yeah, well, I mean, I've been talking about it for years.
This is all for Matt, we know.
The thing is, so I left and moved to Germany where, your taxes pay for everything.
That's right.
And then I came back here in 2022 where your taxes are just, I don't know, sent off into the abyss and no services are paid for, right? And all of a sudden there was no more SALT. There was no more SALT deduction.
Yeah.
My Republican friends always say, well, it's your fault for living in New York. You should move to Florida, to your Palm Beach comment, right? How has SALT affected the market?
I mean, I think it was also a negative narrative. That cap of $10,000, it drove a lot of people. We saw people leaving New York, and going to lower tax states. And I think it's going to expire in 2025, as you talked about in your previous segment, and I think it's either going to be repealed or modified because I think both the Dems and the Republicans want it to go away. It doesn't help New York, which is a place that's struggling already. We have a lot of challenges with the legislature in Albany, the tax policy. People want to live here. They want to raise families here. It's, in my opinion, New York is the best city in the world, and people want to be a part of it. And I want to make sure that your life is better too, Matt.
Here's the thing.
Don't worry about his life.
I mean, that's why people vote, right? To improve their life or move, right? Did you see a lot of people who, if you want to move to Bronxville, you face massive taxes. You might rather be in Palm Beach. Did you see a lot of people shift?
During the pandemic, as we all know, people left New York City to go to other places like Connecticut and Florida, or, they wanted to get away from what was going on because of the pandemic, right? And I think people went there, and we saw a big return back to New York because this is a fascinating place that people want to be a part of. I always say, how much tennis can you play in Palm Beach? You want to come back to the city and be a part of the talent capital of the world. And I think, we did see people leave, but people have come back. And
they have investment banks down there now. They have
we have offices there. We love Palm Beach. We have great markets in Palm Beach and in Miami. I love Florida. It's a great place. But I think, people have to look out, like you were saying, you have to raise families. You have to pay bills. And I think that people take all of that into account.
So what are they looking for at the end of the day? Is this going to come down to price? Is it going to come down to location? When you are talking to buyers at this juncture, Where are they looking to move and why?
You know, it depends. So it's always very personal, and the market is there to serve their interests. So it depends. If they can find something, as Barbara said, now, it's a great time to get into the market, because I think as rates start to go lower and lower, it's going to get more competitive. So if you see something, you know, make a bid, work on it. You know, there's a lot of opportunity out there. I think it's going to be a good opportunity real estate market. I'm more positive now than I felt in a long time.
How frustrated, though, are, you know, the kids, Gen Z, the millennials? You have teams of families out there in their 20s and 30s making good money that cannot afford to get into this housing market.
I hear that, and I feel that, because, you know, I do think having a home is a piece of the American dream, or maybe it's being a TikTok influencer. I don't know. But I do think maybe it's not the American dream anymore, but I do know that it is a commitment to your economic security and to building intergenerational wealth. And Gen Z and millennials want a part of that. And I think, as I say to my kids, when you have a little bit of money, buy your first, whatever it is, it's the best investment for your life, and you build wealth that way, and you have a home.
But that's what I'm interested in. You said people are moving back to New York City.
Yeah.
Many people who move to New York City are renters, actually,
Yes.
not buyers. And so are people then looking to stay in the rental market at an increased rate, even if you think that prices are going to be at a place to buy significantly, because they want to be in a city?
Yeah,
They wanna be in a big city.
look, New York is a rental city. The majority of our housing stock, I think something like 70%, it's rentals, you know. So, and it gives people an opportunity to test out the market, to see if they want to be here, to stay here, and move around a little bit until they decide they really want to be here, and then they'll buy something. So I think renting is a good thing too. It just depends. But ideally, for the long term, for an investment, if you have a little bit of cash, it's great to park it in your first, even if it's a little teeny studio or home, it's a really incredible investment.
Is inflation real? That's been a big conversation.
The rent is too damn high. But I mean, look, it's been going up, 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 and hasn't really come down. Maybe we will start to see more pressure off of the rental market and onto the buying and selling market, and that will bring those prices down a little bit.
Do people have to settle for smaller homes, given where pricing, supply
That's always been the story.
is?
That's why I moved to the suburbs.
Yeah,
right?
I mean,
how bad is it getting?
I think it depends on where you are, right? And I think you have to always compromise. Compromise is sort of the energy of the good here. You know, you have to be willing to give up some stuff. And so, yes, you may have to get smaller, not the best location, not exactly what you want, but it's something. And it's a place to start. We all have to start somewhere, right? So I think there's opportunity out there, and I'm really optimistic.
Share a room in order to build that extra movie theater?
I want them to share a room in order to build character.
What's wrong with that's what I'm saying.
Yeah.
You don't want to give them too much. Sharing a room is a good thing. My brother shared a room. Listen, I always talk about, I had a babysitter for my kids for a long time. She came from Trinidad. Her first investment, she bought a little house in Queens. She raised her 4 kids there. She built her life there. And it's always been an inspiring story for me, because it's been the way that she's been able to function and live and thrive. And that's the American dream. And that will always continue.
American dream.
American
Well.
dream. Keep it up, Matt. Don't give up on that
Don't
dream.
give up. Bess Friedman, Brown Brothers, Brown Harris Stevens, CEO. We thank you so much, of course, on the heels of that historic rate cutting cycle. Let's go to check on the markets with Bloomberg's Abigail Doolittle. Abby.
Well, ahead of the potential first cuts in 4 years, Shonali, stocks, well, they're treading water. Take a look at the S&P 500 E-mini futures. Overnight up slightly, but down just a little bit, up slightly, and now down about very, very little, less than 0.1%, about the equivalent to the upside. This little leg lower overall, maybe down 0.2% from those fractionally highs. That has to do perhaps with James Bullard saying on CNBC that the case for 50 basis points may be overblown. So we have some Fed talk right here in terms of the idea that that could be overblown. Let's take look now at the other markets that we're watching. The NASDAQ 100 flipping higher. It had been lower, small move. Where we do have a bigger move, 2-year yield now up 5 basis points. It had been up just 2 basis points. So again, it seems as though some traders are really rethinking whether or not it could be 50 basis points or not. The dollar not doing much. And then NVIDIA, this is a risk on, risk off tell instead of, say, the VIX or Bitcoin. NVIDIA down about 0.3%. So not really moving all that much. Investors really want to know what's going to come out of this policy decision. And of course, the press conference afterwards. Relative to sectors, this is the S&P 500, and you can see that technology here. This is the sector, the amount I'm having a hard time reading this chart because I've actually, Shonali, never seen it in this form. But I think that the tech here, it's saying that it's up about 0.1%. Financials down 0.4%. Discretionary up 0.1%. So in any case, very small moves. Theme of the day, ahead of the Fed, stocks and assets overall, except maybe bonds, treading water.
I've never seen that breakdown in the pie chart
You
either.
kidding? Yeah, I'm not sure what
I mean, I've
the
seen
version.
IMAP. I've seen IMAP, obviously, but I've not seen that specific breakdown.
Pie charts are controversial. I do like them.
I love the Venn
will
diagram,
say,
you know?
Abby, thank you so much. Now coming up, the business of higher education is under strain. Former Purdue president Mitch Daniels said that colleges around the world are seeing shakeouts in their business models. We're going to talk about that next for Wall Street Week Daily. This is Bloomberg. And it's time now for our daily Wall Street Week conversation. Campus unrest is not the only challenge facing colleges and universities. Their business models are being called into question and the value of a college degree. David Weston asked former OMB director and former Purdue University president Mitch Daniels why the costs have gone up so much.
The system's sort of built for higher pricing. I mean, if you had total pricing power in any business, in other words, you could raise prices and you not only don't lose customers, you may gain more. That's because there's no quality measurement. People have associated the price with quality. No proof that that's true. But that's certainly one reason. The people, David, you know that the hardest business to change is one that's succeeded for a long time. And this model, if you call it that, was very successful. Had the wind at its back, lots more young people in the country, young people being told you got to go to college, 4-year college, and they followed the path of least resistance. Now, very belatedly, there's a little consumer resistance.
Well, is it succeeding? Is the system succeeding right now? And what is the goal? How do we measure success for higher education?
Well, when I said succeeding, I meant they were able to perpetuate themselves in their institutions. I didn't mean it was necessarily succeeding for the students. That's a whole other question, which again, way too late, is being asked more and more forcefully. But no, a whole other discussion whether the system as we have been operating it has been teaching what it ought to teach, teaching it as rigorously as it ought to be taught, and therefore whether the young people emerging meet either of, I would say, the two basic tests of success. One, are they ready for highly productive work somewhere in the economy? Two, are they prepared to be knowledgeable, engaged, active citizens? And by those two measures, the system hasn't been doing, in general, too good a job.
In business, there's a certain accountability. You allocate money, you allocate resources and capital, depending on whether it's going to return a profit to you or not. And if you don't do that successfully, you go out of business. Is there an equivalent in higher education? What holds accountable? What in the system does?
Again, without delivering necessarily the results that one would hope for the students, schools until the last few years were able to, by their own lights, do just fine. They were taking in lots of money, they were growing, they were keeping all the constituencies on campus happy. Finally, slowly, the market has begun to react to that. So you're seeing now a system beginning to experience the shakeouts that other sectors have as demand for their product shrank, or disruptive new alternatives to what they were selling came online.
We're starting to see some colleges really getting a lot of financial pressures. In fact, some even going out of business, and others really looking at other ways to do their business. Are there business principles that could be applied to higher education that do apply there that could help them financially?
Yeah, sure. I've always begun an answer like this by saying higher education is not supposed to be a business. I used to say the same thing about government, but it can be much more business-like. It just didn't have to in too many cases until recently. I would say that the good news is there's a lot of low fruit, a ton of it. Look at these schools that astonishingly have more administrators than students. I mean, a lot of that could disappear. I used to say to people, you'd be amazed how much government you'd never miss. There's a whole lot of sort of, let's call it government inside higher ed that is really not central to any mission they should be practicing. And on the other hand, the cost structure is very rigid in too many cases. Personnel is by far the biggest cost. A lot of that is locked in, tenure and so forth. And so it makes it hard for those schools that either have awakened to the need to keep college affordable for students, or who are being pressured to do so by falling applications and so forth. I guess the last thing is there's a people issue to some extent. 80% or something like it of all the people leading our schools didn't come up through business or anything resembling it. They came up through this highly successful, pretty easy, easily managed structure. Every year it was only a question of how much more we could dial up the cost to produce the revenue, to keep everything going and make everybody happy. And so that's not very good preparation for a new era of exigency.
And that was former Purdue University President Mitch Daniels. David Westin joins us now. So I wonder what would be his prescription then for kind of righting this ship?
Well, part of it he did at Purdue. He went to Purdue a good long time ago, after he'd been governor of Indiana. And what he said was, instead of every year asking how much money do we need to do what we want to do in the university, he asked, what happens if we don't raise tuition? So they have not raised tuition. It's now going to be, in 2026, it'll be 13 years. They've not raised tuition. And if you look at the lines for Big Ten schools overall and Purdue, it is really stunning. Purdue is just a level set. The Big Ten kept going. So one of the things he did was saying, well, let's just say, let's live within our means and see how we do.
Well, it's interesting because we were talking a little earlier about how the rent is too damn high. You would say the same for American education these days, isn't it? What is the cautionary tale here if more colleges, not firms, don't go in the way of Purdue?
Well, if you look at it, you're seeing the cautionary tale in some of the things we talked about. You see a bunch of universities we know about who are cutting back on their programs, cutting back on some of their departments. We even see some educational institutions going out of business altogether. So there's really some discipline coming into the system because people just can't afford it. As you point out, I mean, it's really exceeded the cost of living increases for many, many years. It's been too expensive. And people are not just saying it's too expensive, they're also saying, is it worth it? Do I really need that liberal arts education today?
That's a great question. I mean, I think, this is just my opinion, everyone should be able to afford to go to college. But I'm not sure if everyone should go to college or needs to go to college, right? I spent a lot of time in Germany. They have an apprenticeship program there, and they do very well. Of course, if you're a tradesman here in the U.S., you can make a really good living.
And we have a shortage of a lot of those tradesmen, actually. And as you say, you can make a good living, and you can raise a family, and you can buy a house and everything else. And there's been perhaps too much of an emphasis, maybe going back to the GI Bill after World War II, right, where we really were sending all those GIs coming back to college. There may have been too much emphasis on that. But there's a lot of scrutiny. By the way, we cover not just the United States, we also cover the United Kingdom. We go over to Gillian Tett, who is at the Financial Times, but now she's also provost at King's College, Cambridge. And they have a lot of the same problems over there and how they're trying to get their students ready for this economy.
All right, really looking forward to it. Again, you're launching a new Wall Street Week. That airs at 6 p.m. on Friday. Definitely be sure to tune in. David Westin, thanks very much for joining us. Remember, new Wall Street Week. So it's a new program airing this Friday at 6 p.m. New York time and every week at that time thereafter. This is Bloomberg. Welcome back to Bloomberg Open Interest. Matt Miller here with Shonali Bassick, and we are both pretty pumped for Fed Day.
Bated breath, really.
We're waiting with bated breath to see if we get... Actually, I just want to know if we're going to get 25 or 50. You probably want a little bit more detail than that.
I want to know everything about where we're going from here, but it's interesting. You're seeing 8 days of gains in the S&P 500 really start to, let's say, hit a wall. We are not going much of anywhere today, are we?
Yeah, no. Yesterday we came up against the all-time closing high at 56.67 at about this time, and then retreated. You can see right now that we're trading at 56.35, so we're a solid 32 points away from an all-time high. We don't show the equal weighted S&P. But we did see an all-time high there, right?
But stalling out today once again. You have to wonder how this Fed decision will change the dynamics in the market. There are plenty of people who we've spoke to that say not very much at all, but there is a chance here that way too much was baked in, and then we have to worry about volatility once again in these markets.
You mean that the market expects too much? I mean, you were looking at Bruce Richards' Twitter earlier, and he said, you know what, 90% of economists and Fed watchers expect 25 basis points, whereas the market is pricing in a 70% chance that we get a 50 basis point cut.
It's screaming 50, and if it's screaming 50, you have to wonder if both stocks and bonds are currently overpriced.
All right, definitely stay tuned for special coverage of the Fed decision that starts today at 1:30 p.m. Eastern. The Fed decides on Bloomberg Television, on Bloomberg.com, and my preferred way to watch this is on Apple TV. You can click on the Bloomberg app there. This is Bloomberg.